Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Steve Dainard, mortgage broker in Niagara Falls, Fort Erie, on.
If you own a home in Niagara Falls and you're behind on property taxes right now, the clock is already running. So the question is, do you actually have options before that deadline arrives?
That is the question, and the answer is yes, but only if you move before the window closes.
Let's set the scene, because this is a situation more homeowners are facing than most people realize.
A homeowner in Niagara Falls. They've got equity in their property, they've been through a rough stretch financially, and the property tax arrears have been building.
And they go to their bank, thinking the equity in the home is going to be the thing that saves them.
And the bank's automated system declines the file before a human being ever looks at it.
That's the part that stops people cold. They have real equity, a real asset, and the answer is still no.
And this is where Steve Dainard's work in the Niagara Falls and Fort Erie market becomes genuinely important, because that's not the end of the road.
Steve Dainard is a mortgage broker specializing in alternative mortgage financing, working across the Niagara region, Niagara Falls, Fort Erie, Welland, Thorold, St. Catharines.
And the specialty matters here, because alternative financing is not a fallback. It's a different tool built for a different borrower profile.
So let's talk about why the bank said no in the first place, because it's not personal and it's not arbitrary.
The standard bank approval process is built around a very specific borrower: T4 employment income, strong credit history, low debt, conventional property.
When any one of those variables is off, the system declines. That's a structural feature of how banks are built, not a judgment on the borrower.
And for a homeowner facing a property tax deadline, the timeline itself is often the problem. There's urgency that the bank's process simply isn't designed to accommodate.
So what does the alternative lending landscape actually look like for someone in that position?
Alternative mortgage financing covers private lenders, credit unions, monoline lenders, and B lenders, institutions that apply more flexible underwriting standards in exchange for different pricing.
And the key word there is different, not impossible.
Right. These lenders look at the whole picture. The equity in the property, the story behind the credit, the actual cash flow of a business rather than just the net income on a tax return.
Steve Dainard works with all of those lender types, and that access to a wide network is what makes the difference when a file doesn't fit the standard mold.
Let's stay with the property tax scenario for a minute, because the mechanics matter.
Walk us through what actually happens when a homeowner in Niagara Falls is facing that deadline.
Ontario municipalities follow a defined legal process. Once a tax arrears certificate is registered, the homeowner has a limited redemption period, typically 1 year, before the municipality can move to sell the property.
And a private mortgage can be used to pay out those arrears, clear the lien, and stop that process.
But here's the critical piece. Arranging that financing takes time. There's an appraisal, a title search, lender underwriting, legal closing.
So waiting until the last moment is not a strategy. Starting the conversation now, while there's still runway, is what creates options.
And Steve Dainard is direct about this. The first question is whether there's enough equity in the property to support a private mortgage that covers the arrears.
Every property is different, every file needs to be looked at individually, but Niagara Falls properties have held reasonable equity positions even through the recent flat market.
And this points to something broader about how alternative mortgage financing actually works in practice. It's almost never a permanent solution.
It's a bridge. It stops the immediate damage and buys time.
The follow-up work is rebuilding the financial picture so that a conventional or B lender product becomes accessible within a defined time frame.
That strategy conversation, what comes next, is as important as the immediate transaction.
Let's shift to another major segment of borrowers Steve Dainard works with in the Niagara Falls and Fort Erie market: self-employed borrowers.
This is the most consistent segment in the alternative space, and it's one that surprises people because these are often financially healthy borrowers who just can't get a bank to look at their file.
Statistics Canada puts self-employed Canadians at roughly 15% of the workforce, and they're disproportionately represented among mortgage declines at major banks.
Because the bank lends against the notice of assessment number, and for most business owners, that number is lower than actual earnings because of legitimate write-offs.
which is smart tax planning, and it creates a documentation problem with conventional lenders.
Alternative lenders solve that with what's called a stated income or business for self program, looking at gross revenue, bank deposit history, accountant letters.
It's a recognized underwriting methodology for a borrower profile that the standard system handles poorly.
Steve Dainard's approach here is about telling the income story in a way that makes sense to the specific lender, knowing what each lender actually needs to see to get comfortable with the file.
That's not about credentials, it's about knowing the landscape, which lenders have appetite for which file types.
And that knowledge is what separates a declined file from an approved one.
Credit challenges are the other major driver of alternative financing in this market, and it's worth being clear about what that actually means.
A damaged credit profile doesn't automatically close the door on mortgage financing. It changes which lenders are in play.
Private lenders, in particular, focus more on equity than on the credit score itself. A borrower with significant equity and a low credit score may still qualify where a borrower with good credit and minimal equity would not.
And the credit story matters. A single missed payment following a job loss looks very different to a lender than an ongoing pattern.
The practical path Steve Dainard outlines for credit-challenged borrowers is a two-stage approach. Secure the financing that's available now to stabilize the situation, then work on the specific credit factors so a better product becomes accessible at renewal.
A private mortgage with a clear plan is a reasonable strategy. A private mortgage with no plan is just a more expensive mortgage.
That's a direct way to put it, and it's the kind of honesty that matters when the costs are real.
Let's talk about costs, because alternative financing is more expensive than bank financing. That's a straightforward fact.
Private lenders carry higher rates, and lender and broker fees are typically part of the structure.
The value isn't in the price, it's in the access. For someone facing a foreclosure deadline, the cost of a private mortgage is almost certainly lower than the cost of losing the property.
And for someone who could qualify for a B lender product with a few months of credit rebuilding, it may make more sense to wait.
That's the honest read that Steve Dainard brings to the first conversation. Which category does this situation actually fall into?
There's another piece of the Niagara market that doesn't get discussed enough: lower value properties, particularly in Fort Erie and surrounding communities.
Traditional lenders have a fixed cost problem with small loan amounts. The administrative cost of originating a small mortgage is nearly the same as a large one, but the income is a fraction.
So they decline. And that leaves first-time buyers, lower-income households, people purchasing in less active markets with very limited options.
Alternative financing fills part of that gap, but the pricing reflects the lender's economics, and on a small loan, fees and legal costs represent a meaningful percentage of the total amount borrowed.
Steve Dainard is clear that understanding those costs in full before committing is not optional. It's the only way to make an informed decision.
There's also the vendor take-back option for lower value properties, where the seller provides financing directly to the buyer, sidestepping the institutional lending problem entirely.
Different legal and financial considerations, requires proper legal advice, but it's a real option worth understanding.
Let's talk about what the process actually looks like from first call to funded mortgage, because a lot of the anxiety around alternative financing comes from not knowing what to expect.
The first stage is the intake conversation, understanding the full picture of the borrower's situation, the property, the goal, and the timeline.
And Steve Dainard is direct that not every situation is a mortgage problem. Sometimes the first call surfaces that a different approach, a repayment plan, a credit rebuilding strategy, is actually the better path.
From there it's documentation, lender placement, commitment and conditions, and legal closing.
The timeline depends on file complexity and how quickly documentation can be assembled. Every transaction is different.
But the sequence is clear, and knowing that sequence removes a lot of the anxiety that comes with being outside the standard bank system.
One thing Steve Dainard is explicit about: alternative financing is not the right answer for every situation.
If the underlying financial problem is not solvable by adding more debt, a mortgage is not the solution. The lender gets paid out, the cash flow problem remains, and the next deadline arrives.
And if the equity position is insufficient to support a private mortgage at a loan-to-value ratio that makes sense, Pushing through that transaction doesn't protect the borrower.
The situations where it genuinely makes sense are the ones where it solves a defined, temporary problem and creates a clear path to a better product.
A private mortgage that stops a foreclosure and gives a homeowner time to sell or refinance at better terms. That's the right use of the tool.
Getting a straight read on which category a situation falls into is exactly what the first conversation with Steve Dainard is for.
And one practical note: in Ontario, all mortgage brokers and agents are licensed through the Financial Services Regulatory Authority of Ontario, FSRA. You can verify a broker's license status directly on their website before engaging.
In the alternative space especially, where transactions can be complex and cost significant, that's a step worth taking.
What I keep coming back to in everything Steve Dainard has laid out here is that the common thread is time.
Getting straight information early, before a deadline forces your hand, almost always leads to a better outcome than waiting.
Whether it's a property tax deadline in Niagara Falls, a self-employed borrower who's been turned down by 2 banks, or a buyer trying to finance a lower-value property in Fort Erie, the earlier the conversation starts, the more options exist.
That's the real takeaway. The alternative lending space was built for people the traditional system wasn't built to serve, and those people deserve honest, clear guidance, not a runaround.
The lesson here generalizes beyond any single scenario. The system saying no is not the same thing as there being no answer.
If you're in the Niagara region and you're facing one of these situations, Steve Dainard is the conversation worth having.
Steve Dainard is a mortgage broker in Niagara Falls, Fort Erie, specializing in alternative mortgage financing.